All right. Good afternoon. It doesn't look like we have anybody on yet, so I'm going to give it a few more minutes to allow anybody that plans on joining to do so. I do record these videos and post them to our website for future review, so anybody that registers is able to get a copy, as well as uh, anybody that goes to the website and clicks on our events page is also able to watch and observe these videos. So I will give it another minute or two, and then I'll go through what I have to say, and we'll get it done quickly. So okay, looks like we've got a few people joining us here, hopefully. So we'll give it another minute or two. Hopefully everybody's enjoying, at least everybody on the West Coast is enjoying the nice weather. I know those on the East Coast are dealing with a little bit of frigid temperature right now, so we'll give it another probably 30 seconds or so before we get started. Um, Take a sip of water. Make sure I can get through this without any interruptions. So, all right. Well, since it's just looks like a small group this afternoon, I'll just go ahead and get going. And like I said, this is recorded for future future viewing. If anybody desires, they can look on the website or get an email if they register. So, thank you for joining me today for this webinar, this monthly market update. This continues my sessions to discuss what is happening in the markets and the global and domestic economy, and to provide you an opportunity to ask questions or get some answers to things that you might be hearing or seeing and how they might impact your personal finances and financial plans. So in addition to the email you should have received inviting you to this webinar, that should have included a market update quick hits summary that is provided in the invitation. In addition to that, there should have been a link to the video blog post by Chris Fasciano, who is Commonwealth's chief market strategist. So Chris provides his videos as a quick summary to the important factors impacting the markets and the economy. And so that goes hand in hand with this video as well. So let's get into it a little bit. I won't dive into quite as much detail as Chris gets into. Sometimes they can get really wonky and nerdy with the data. But I'll talk about a few things. So first thing is just kind of go over the quick hits. As most people are aware, the markets continued to rally in October, driven by improving fundamentals and supportive monetary policy. Falling short-term interest rates and stronger than expected earnings growth supported the rally amid delayed economic updates, and that is being driven by the government shutdown. Looking forward, risks remain, but economic growth and market appreciation remain the most likely path. And so in addition to that, some of the additional bullet points, stocks hit their 6-month mark in terms of a rally from the April lows. The Federal Reserve continued to cut rates in October. The economic reports indicate inflation is gradually rising a little bit from the lows that we've seen, and there's reason for cautious optimism, even though we have political uncertainty right now. Looks like we're headed towards the government getting reopened. So cautious optimism. So that's the quick hits that you should have received in the email. Now we can kind of talk about some of the details about what we're seeing. So let's first start with How did the markets perform in the month of October? So to start off, October was another good month to be an investor. All of the major indices were positive for the second month in a row, again hitting new highs with a slight dip early in the month of October. For the month, the S&P 500 was up 1.92%, the Dow Jones was up 2.4%, and the Nasdaq was up 4.26% for the month. Additionally, international stocks were up 1.5%, and the aggregate bond index was also up 0.38%. So all across the board, positive index growth in the markets. Now, if we go out a little bit longer and we look at what the year-to-date performance, so year-to-date, even despite the longest U.S. government shutdown in history as of now, the markets are continuing to show strong growth for the year. As of the end of October, the Dow was up 11.8% year to date. So as of from January 1st to the end of October, the S&P 500 was up 16.3%, and the tech-heavy Nasdaq is up 22.86% year to date. Those are great numbers. Additionally, international stocks have grew a whopping 29.2% for the year to date, somewhat helped by the softening dollar. And bonds are up 6.8% so far. So again, this has been a pretty good year to be an investor, regardless of how you have been investing. So if we talk about the stock market in general, the S&P 500, the Dow, and the Nasdaq, the market indexes are primarily up due to the companies inside them, those indexes, reporting stronger earnings, and we have seen a remarkably resilient economy so far this year. So per Bloomberg Intelligence, the average earnings growth rate for the S&P 500 this year has been 12.98%, so 13% earnings growth. Now, this is well above the analyst estimates of 7.35% at the start of the earnings season. So since fundamentals ultimately drive long-term market performance, this was an encouraging development for investors. And I will say the key question, and one thing that people are talking about is whether the markets are overvalued. And there's a lot of ways to measure valuation. The most common being the price-earnings ratio, which is nearing close to historic highs again, and that is something that we should be watching out for. The bond market has also continued growing on the recent Federal Reserve rate cuts, with reasonably strong expectations for future rate cuts going into 2026. So on this past October 29th, the Fed cut the short-term rates by an additional 0.5%, as the market largely expected, bringing the target range between 3.75 and 4%. And they've done this primarily due to softening jobs reports and inflation reports that show that inflation, while not eliminated, has largely been put in check to less than 3% year over year. And going forward, there's an expectation that the Fed is going to potentially cut rates at the end of the year in December by another 0.25%. That may be sort of 50-50 right now, but that is going to provide some additional relief to the economy going into the holiday season if they do that. Now, caveat, especially for folks that are looking at buying a house, is that mortgage rates don't always move in tandem with short-term rates. Because a 30-year mortgage rate is something that the interest rate on that is not really always tied to the short-term rates. Also, there is an expectation right now, at least, that the Fed is going to continue cutting rates in going into 2026 by potentially up to another 0.5%. So and that would bring the Fed funds target rate to somewhere around 3%. So we're about 3.75% right now. So possibly we could get to 3% by the end of 2026. Now, a lot of this will hinge on the jobs reports that will be coming out over the next month or two, how the holiday shopping season goes, and if the U.S. economy is able to maintain its current pace. Falling rates are good news to some bondholders and bond fund holders because as rates decline, existing bond values rise. So this may be the opposite of what we saw in 2022. 2022, we saw both the stock and bond markets decline in the same year when oftentimes they offset each other. This is a situation where it's exactly the opposite, is that where both bond and stock markets are rising together and not offsetting each other. So again, not a bad thing for if you're an investor. The direction of overall employment seems to be one of the biggest watch outs right now. Now that the federal government is hopefully going to be reopening soon, we will be able to get access to the overdue employment reports and get a better picture on the employment situation. Most are expecting the job market to continue softening over the next couple of months, but that's not surprising given the abnormally strong job market that we had over the past couple of years. So this may be a little bit of an effect of the market normalizing. There's also some speculation that it's tied to artificial intelligence, but I think personally, I think that may be a little preliminary. So a lot of things are being attributed to artificial intelligence right now, and I don't think it's quite as clear cut. So there are, of course, other risks to watch out for, particularly foreign risks. It does appear that the Israel-Gaza ceasefire is continuing to hold, so fingers crossed that that will continue. As for the Russia-Ukraine conflict, that still doesn't appear to have any end in sight. A resolution to both of these situations would have a positive effect on both the U.S. and international markets. So hopefully we'll see more progress on the Gaza situations because that seems to be at least holding for the time being. So to summarize, October was a positive month for the markets and investors, and so far that appears to be continuing. It's another reminder, that despite what's going on in the world and politics, the markets are not always directly impacted by the things that we see in the news headlines. The primary driver for, at least for stock market returns, is profit growth. And so far, that has continued to be strong and largely being driven by optimism and effects around technology and emerging AI technologies. So now that's not going to last forever. The softening jobs market, as I mentioned, is something that we need to continue watching and closely. But I'm not immediately anticipating any crash or collapse, as some people might be speculating. We could see some economic softening in the future if the jobs trends continue. But I don't see any, 08, 09 type of a collapse coming. Could we see a tech pullback, something similar to 2022 going into 2026? Possibly, but again, like I said, as long as companies are still cranking out profits, that tends to lead the market up. Okay, so anyway, that's my 2 cents. Now, the dynamics that we saw earlier in this year, particularly in April, serves as a reminder that investing does have risks of loss, especially in the short term. So a well-diversified portfolio that matches your goals and timelines does tend to be the best path forward for both benefiting with market appreciation, but also protecting against excessive losses. So I'm not going all in on gold, and I'm not going in all in on Bitcoin or AI. But having some portion of those things in your portfolio is not a bad thing to do. All right. Let me open it up for any particular questions that anybody might have. It looks like just a sparse attendance today, but that's okay. I can answer questions offline as well if there's no direct questions. So I'll just give it a second. All right. If there's no questions, just to summarize, I do thank you for your participation in watching this today. I'm going to do this again in a month on Wednesday, December 10th. But that will also be back at the regularly scheduled time of 11 a.m. So 11 a.m. on, in fact, let me jump to the slide with the information on that. Okay. So Wednesday, December 10th at 11 a.m. is going to be the next market update, typically done on the second Wednesday of the month. And I adjust based upon what's happening in the markets and when the reports come out. So just keep an eye out for the invitation. And if you have any friends or family that you think would enjoy participating or want to have ask questions, you feel free to forward this to them. I also have other scheduled webinars on various financial planning related topics. The next one is going to be on charitable planning to be held next week on Wednesday, November 19th at 12 p.m. You can find my previous videos on various financial planning topics on our website under the events section. Under past events, just click the watch for the recorded video link and it will take you right to the video. And as always, if there is a topic that interests you, please shoot me an email and we'll see if we can get that scheduled. Some of the possible topics on the list for 2026 would include things such as retirement plan options for small business owners, protecting yourself against yourself, and understanding investor behavioral finance and excuse me, protecting yourself against yourself, understanding investor behavioral finance, and psychological bias that affects investing decisions. I might also do one on Roth conversion strategies, homeowner and other property insurance considerations, and I might do one on alternative investments that people don't seem to know a whole lot about, so, such as private equity and venture capital and private credit, those types of things. So those are some ideas, but if you have some additional ideas you want to share with me, shoot them to me and I'll see if I can either do one myself or bring a guest speaker in to talk on the topic. So, all right, that is all I have for the time being. If there isn't anything else, I wish you a wonderful November, and I will see you next either on the 19th of November or the 10th of December, whichever one you prefer. So, and otherwise, I do wish everyone a happy Thanksgiving holiday and enjoy your fall and winter. Thanks a lot, and take care.